what stage do you plan or think you can get an exit, Emmett?
Well, that changes over time. To a certain extent, we're in a market now where there's no public alternative. So the companies know that, and so they can take their time and they can kind of wait and offer different deals and take a little bit more time, and they can wait for more data, frankly. I think at this point, and I had a meeting last year, and I asked that specific question to a panel of 8 company representatives, and to a person, with one exception, they said, I want to see robust phase 2 data. One company, which was Bausch & Lomb, and this was a public forum, said, I want to see phase 3 data. So that's a lot of data before they'll do a deal, to see robust phase 2B data. But that was, at least at that point, 1 year ago, what the companies wanted to see. So they want robust data, which speaks to how uncomfortable they are with that indication, I think. In medicine, there's a dictum that when you have many drugs to treat a disease, probably none of them are great drugs. And when you have many endpoints for an indication, probably one of them isn't the obvious endpoint.
Yeah.
So.
And Dana and Cedric, as you talk about having smaller funds and being capital efficient, knowing that these phase 3 and phase 2 are larger indication or larger costs, essentially, how do you guys manage the investment?
It's pretty binary. If J.P. Morgan at the beginning of the year was any indication, you had 2 groups. You had the A investors. Not that they're better, but A investors and B investors. The A investors basically telling the smaller companies that might have some preclinical data that you need to get into the clinic before we'd even look at it at all. And then there's some of the B group that would, in fact, take the gamble. So we're obviously in that second category. And what we need to be cognizant of, knowing that the syndication may be tougher because these guys are going to wait, is that we need to be able to at least provide enough capital internally to get through at least some major value creation points. Not the IND filing, but at least the phase 2 completion, top line or beyond. And so and that's what was attractive to at least dry eye. Now, as we all know, dry eyes, you keep peeling the layers off. There's increasing complexity at each step. But if you look at it from the top line, we felt that we could at least get to a phase 2 completion with a fairly targeted clinical trial with this compound. And then hopefully we could get some interest at that stage, because if we needed it to go into the phase 3, which is not in our exit plan, that changes the dynamics tremendously in how they look. As Emmett said, in the 80s, the IPO market was pretty strong, and now it's just gone this way, where M&A is strong now, and IPO is almost, it's like 5 out or whatever in life sciences, almost the opposite. And so, a fund like ours, it helps us because we don't need that public market out there in a sense. We could return our fund, because it's small, with 1 or 2 good deals, basically. We can turn the principal to our LPs that way. So that is a nice thing in a sense, and the IPO market is just gravy at that point. But of course, we're a small player in that, so we'd have to keep feeding to get mezzanine to get to that stage as well.
The one comment I would add is that if you look at the historical rates of returns and you try to correlate it with the amount of capital that goes in a company, if you don't put enough, your returns are low. If you put too much, actually the returns are low. So you actually have an inverse U-shaped curve. And then what is the optimal amount of capital? What's the optimal amount of products that you need to have? What's the optimal mix of products that you need to have in a company to generate the return? And there's always obviously exceptions at both extremes. The reality is that we believe that if you analyze the companies that tend to raise more capital and have more products, unless there's a platform linking all of it together, they tend to be great IPO candidates. The problem is that there's no IPO market right now. And so therefore, it's not impossible for the companies to go public, or at least it's super selective. So if you can't do this, and if you don't want to sell the assets one by one, do you go the other way? Should you have companies which are effectively glorified projects to a certain extent with a pipeline that's relevant for the company, try to be more capital efficient? I think the jury is still out. There's good models of both types of investment and good models of return, but you have to be wary of the extremes. Not enough capital, which might be a problem. Too much, which creates a hurdle. It creates a stack of capital. And for and it creates a big hurdle in order to create the financial return for the investment.